Hi guys! Enjoy John's analysis.
Since February 28, 2026, gold has fallen 18%. The SPDR Gold Shares ETF lost $4.2 billion in the first 7 days of the Iran war, the largest weekly outflow in the fund's history. Investors who bought gold as war insurance watched their policy lose nearly a fifth of its value in 4 weeks. And Bitcoin, the asset that every mainstream financial analyst classifies as a high-risk speculative instrument, is up 8% over the same period, outperforming gold, the S&P 500, Asian equities, and every traditional safe haven simultaneously. Nobody in the mainstream financial media has a satisfying explanation for this. Before we dive in, a quick word on the framework we'll be using. The core ideas in this video come from the geopolitical analysis of Professor Jiang, a Chinese-Canadian educator, YouTuber, and self-described predictive historian behind the popular channel Predictive History. Jiang is known for using historical patterns, game theory, and structural analysis to forecast major global events. He gained significant attention for accurately predicting Donald Trump's return to the White House and the outbreak of the current US-Iran conflict well in advance. His lectures blend deep readings of thinkers like Alexander Dugin with observations about great power cycles and monetary transitions. This video heavily draws on Jiang's third Rome framework, his interpretation of how Russia, and potentially other powers, is positioning itself as a coherent fortress civilization, while the current unipolar order fragments. However, we explicitly reject many of his broader conspiracy theories, his skepticism toward Bitcoin, and some of his more controversial claims. We use his geopolitical lens as a powerful analytical tool, not as gospel. And we will present both the strengths of his observations and the significant bear cases at every step. This channel does not predict prices. What this channel does is read the architecture. And right now, the architecture points toward a framework that most analysts will not touch because it sounds too extreme, too conspiratorial, and too uncomfortable. That framework starts not with a market chart or a regulatory filing, but with a 600-page book written in Moscow in 1997 by a man named Alexander Dugin, used as a textbook at the Russian General Staff Military Academy, and translated into every significant geopolitical event of the past 25 years with disturbing accuracy. The book is called Foundations of Geopolitics. And if Jiang's reading of it is correct, if the world is not stumbling toward chaos, but being deliberately guided toward a specific new architecture, then the dollar does not just weaken, it loses its structural purpose. And Bitcoin is the only asset that exists completely outside both blocks that emerge from that collapse. This video is going to build that argument from the ground up, with verified data at every step, and with a bear case at every turn. No price targets, no financial advice. The structure of what might be the most important monetary transition in the last 50 years, and why Bitcoin is positioned at the exact intersection of it. In 1997, a Russian political theorist named Alexander Dugin published a 600-page textbook titled Foundations of Geopolitics, The Geopolitical Future of Russia. The book was written with the assistance of a lecturer from the Department of Strategy of the Russian General Staff Military Academy, and according to Stanford's Freeman Spogli Institute, it became the most influential book on Russian military, police, and foreign policy elites published in the post-communist period. The General Staff Academy commander, General Igor Rodionov, was specifically reported to be well-disposed toward Dugin's work, and former Duma Speaker Gennady Seleznyov, for whom Dugin served as geopolitics advisor, urged that Dugin's doctrine be made compulsory in Russian schools. Whatever one thinks of Dugin's ideology, and this channel is explicit that his views on race, religion, and anti-Semitism are repugnant, the empirical question is whether his geopolitical predictions came true. The answer is documented. The Strategy Bridge published a detailed analysis confirming that from the annexation of Crimea to Britain's exit from the European Union, the grand strategy laid out in Foundations of Geopolitics has unfolded with disturbing precision for over 23 years. Dugin's book explicitly called for Ukraine to be annexed by Russia, describing it as posing a huge danger to the whole of Eurasia as an independent state. It called for the United Kingdom to be separated from Europe. Brexit happened in 2020. It called for a Moscow-Tehran axis. Russia and Iran are now coordinating military production and drone technology in the most significant weapons relationship between any two countries outside of NATO. It called for Russia to spread anti-Americanism globally and for geopolitical shocks to be created within Turkey. Turkey's relationship with NATO has been deteriorating for a decade. The Stanford analysis notes there has probably not been another book published in Russia during the post-communist period that exerted comparable influence on Russian military and foreign policy elites. The core thesis of Foundations of Geopolitics is not about winning wars. It is about surviving the collapse of the existing world order. Dugin argues that the unipolar moment of American dominance, what George H.W. Bush called the New World Order in his 1991 address, is structurally unsustainable because it is built on secularism, individualism, and liberalism, which he believes destroy community and ultimately destroy civilizations. His prediction is that Western liberal civilization will collapse from within through cultural fragmentation, political polarization, and the inability of finance-based economies to deliver material well-being to their populations. When that collapse comes, Dugin argues, Russia does not need to win a military confrontation. Russia simply needs to remain coherent, unified, and self-sufficient. And the Third Rome rises from the wreckage of everything else. The strategy is not conquest. The strategy is survival while others collapse. Professor Jiang, whose geopolitical analysis this channel uses while explicitly rejecting his conspiracy theories about secret societies and his Bitcoin skepticism, applies this framework to the current moment with a specific and testable observation. Russia's economy has been restructuring for total war since the Ukraine invasion, with military-industrial output rising, while civilian production contracts, precisely what a society preparing to outlast a long war rather than win a short one would do. Russia began the Ukraine war dependent on Iranian drones and now produces them domestically at an industrial scale, having successfully transferred drone manufacturing technology in what may be the most significant defense industrial technology transfer since World War II. Combined with Russia's control of 1/3 of the world's carbohydrate production through its Ukrainian territorial ambitions and its role as the world's largest fertilizer exporter, Dugin's Fortress Russia, self-sufficient in energy, food, and weapons, is not a distant vision. It is the direction of travel of Russian policy right now, in real time, verifiable in trade data and industrial production statistics. The bear case on Dugin's framework is essential, and this channel will not hide it. Multiple academic analysts, including those at Science Direct, Stanford, and ResearchGate, have described Dugin's work as neo-fascist, his predictions as pseudoscientific, and his influence on Putin as overstated, arguing that even if his recommendations coincide with Russian policy, coincidence is not causation. The framework is unfalsifiable in the precise academic sense. It makes no specific testable predictions about timelines, only directional claims about civilizational trajectories. Russia has paid an enormous human and economic cost for the Ukraine war that a purely rational Duginist strategy would avoid. In China, which Dugin originally described as an existential threat to Russia, has emerged as Russia's primary economic patron rather than its geopolitical adversary, which represents a significant deviation from his original model. This channel uses the framework as a lens, not a gospel, and the lens it uses is Jiang's specific observation that two major powers are now deliberately building alternative architectures to the dollar-based system, not as a defensive reaction, but as a strategic offensive.
Hey guys, I need a quick favor from you. If you're enjoying this video, please smash that like button and hit the hype button after. It really helps the channel grow and tells the algorithm that this kind of deep macro plus Bitcoin content deserves to reach more people. Takes literally 2 seconds, but makes a huge difference for us. See you!
On September 11th, 1991, exactly 10 years before the September 11 attacks that would define the beginning of American unipolar dominance, President George Herbert Walker Bush delivered a speech to a joint session of Congress outlining what he called the New World Order. The 3 pillars of that order were financial supremacy. America would offshore manufacturing and focus on finance, making Wall Street the center of the world. Secular multiculturalism, where the shared love of consumerism would transcend borders and prevent conflicts. And Pax Americana, where the United States would provide global security guarantees in exchange for the privilege of running the world's reserve currency. For 35 years, that system held, and then it did not. Jiang's most provocative argument is not about Russia. It is about America. His claim, and this channel presents it as a framework for analysis, not an endorsement, is that Donald Trump understands, at an intuitive level, exactly what Dugin argued at an intellectual level. The existing system cannot hold, the collapse is inevitable, and the only question is whether you position yourself to benefit from it or are consumed by it. The New World Order required America to be the consumer of last resort for the world, to finance the security of countries that did not reciprocate, to run permanent trade deficits, and to accumulate debt at a pace that has now produced $39 trillion in national obligations, with annual interest payments of $1 trillion. A figure that, as of fiscal year 2026, has officially exceeded both national defense spending of $947 billion in Medicare spending, according to the American Action Forum's analysis of Congressional Budget Office projections. A nation that spends more servicing its past than defending its present is not a nation in structural health. The Trump world order, as Jiang frames it, is the deliberate demolition of Pax Americana in order to build what Secretary of Defense Peter Hegseth publicly called Greater North America, a self-sufficient continental fortress that exports resources rather than providing security. Hegseth's presentation at the Department of Defense using that exact phrase was not a casual remark. Venezuela was effectively absorbed into the American economic orbit in January 2026. Greenland discussions have been ongoing since 2025. The Panama Canal leverage negotiations, the Canada tariff pressure, the Mexico border economics. In isolation, these look like Trump's chaotic, impulsive foreign policy. In the Jiang framework, they look like the systematic assembly of a resource empire that does not need the Middle East, does not need NATO, and does not need to maintain the dollar as the world's reserve currency, because it has something more durable than a reserve currency: direct control of energy, food, water, and rare earth resources on a continental scale. The economic mechanism that Jiang identifies is specific and verifiable. Japan gets approximately 75% of its oil from the Middle East. China imports approximately 75% of its total oil needs, the majority through the Strait of Hormuz. South Korea and India are similarly dependent. These four countries, Japan, China, South Korea, India, are simultaneously the largest foreign holders of U.S. Treasury securities. If you're still here after the 10-minute mark, give yourself some credit. Most people drop off way earlier. The fact that you're still watching shows real discipline and genuine interest in understanding these deep structural shifts. I respect that. Quick favor while we're here. If you're enjoying this video so far, please hit the like button. It really helps the channel grow and tells the algorithm this kind of deep macro plus Bitcoin content deserves to reach more people. And if you haven't already, subscribe and turn on notifications so you don't miss the rest of this series. Now let me know you're here. Comment with your city and country, what time it is right now where you are, and how the weather is over there. I love seeing how truly global this community is. People watching from completely different time zones and climates, all chasing the same edge. It's one of my favorite parts of making content. Go ahead and drop your comment below. I read every single one. Let's continue. Japan holds approximately $1.1 trillion in U.S. debt as of the most recent Federal Reserve data. China holds approximately $770 billion. If those countries can no longer source energy from the Middle East at reliable prices, they need to source it from North America. And to buy North American energy, they need dollars. The $39 trillion debt problem does not disappear, but it becomes significantly less acute when the entire world is structurally dependent on your continent for energy, fertilizer, and food. The Ponzi scheme, as Jiang bluntly describes it, gets extended, not because it is fixed, but because it is now backed by physical resources rather than pure monetary confidence. The bear case on the Trump world order thesis is substantial, and this channel states it plainly. The strategy assumes that the United States can collapse the Middle East energy system without collapsing its own economy in the process, and the $4 per gallon gasoline that Americans are currently paying, confirmed by AAA data as of April 1st, 2026, suggests the domestic cost of this strategy is real and politically unsustainable. The Independent Institute's March 2026 analysis documented that the U.S. government was already on track for a $1.9 trillion deficit in fiscal year 2026 before Operation Epic Fury, and the cost of the war adds to that number without any congressional authorization or offsetting revenue. Trump's approval rating has hit second-term lows according to both the New York Times and Real Clear Politics polling averages as of April 2026. A strategy that is geopolitically clever but politically self-destructive is not necessarily a strategy that gets executed to completion. Jiang acknowledges this tension explicitly, and so does this channel. The dollar's status as the world's reserve currency is not an accident of history or an expression of American virtue. It is the product of a specific institutional architecture assembled in the aftermath of World War II and reinforced in the 1970s through a series of agreements with Saudi Arabia that created what economists call the Petrodollar system. That system has three structural pillars, and all three of them are under simultaneous stress in April 2026 in a way that has no historical precedent. The first pillar is the petrodollar itself. The original arrangement, formalized between the United States and Saudi Arabia in 1974, established that oil, the commodity that the entire industrial world requires to function, would be priced and settled exclusively in US dollars. In exchange, America provided Saudi Arabia with military protection. The consequence was a structural global demand for dollars. Every country that needed oil needed dollars to buy it, which meant every country on Earth was perpetually running a demand for the American currency. That arrangement kept dollar demand elevated regardless of American fiscal behavior, essentially giving the United States what French finance minister Valéry Giscard d'Estaing famously called an exorbitant privilege. That arrangement expired in June 2024, when Saudi Arabia did not renew it, according to multiple analyses, including Financial Content and the Foreign Affairs Forum. Riyadh announced it would henceforth accept yuan, euros, yen, and digital currencies for oil transactions. a shift driven by the structural transformation of Saudi Arabia's customer base, with China having displaced the United States as Saudi Arabia's single largest oil customer. The petrodollar did not die overnight, and most analysts agree that complete de-dollarization is decades away. But the 50-year contractual foundation of the system quietly expired without renewal, and almost no major mainstream outlet covered it. The second pillar is U.S. Treasuries as the world's safe haven asset. The petrodollar recycling mechanism worked because oil exporting states accumulated dollars and parked them in U.S. government bonds, creating a self-reinforcing loop that suppressed American borrowing costs and allowed persistent deficit spending. That mechanism is under pressure from two directions simultaneously. The dollar's share of global foreign exchange reserves has declined from a peak of 72% in 2001 to approximately 57.8% as of Q4 2024, according to IMF COFR data, with the most recent Q2 2025 COFR release showing further decline. Meanwhile, Moody's Ratings became the third major credit agency to downgrade U.S. debt in May 2025, lowering it from AAA to A01, noting that interest payments on debt are projected to rise from 9% of federal revenue to 30% of federal revenue by 2035. The Congressional Budget Office projects that the $1 trillion in interest payments required in fiscal year 2026 will grow to $2.1 trillion by 2036, an increase of 106% that outpaces every other federal spending category. Central banks globally have been responding by purchasing gold at record rates, over 1,000 tons per year in 2022, 2023, and 2024, according to the World Gold Council, more than double the 473-ton annual average from 2010 to 2021. The third pillar is Pax Americana itself, the American security guarantee that made the dollar system legitimate. No country needs to maintain dollar reserves for a security umbrella that is being explicitly withdrawn. Trump told NATO allies in April 2026 that they should take the lead in protecting the Strait of Hormuz because they need the oil and America does not. He threatened to leave NATO. He told the world that Greater North America is now the American strategic priority, not global security provision. The Asia Society Policy Institute published a January 2025 report, authored by Macroeconomic's chief economist Diana Choileva, documenting three scenarios for the petrodollar's future: managed evolution, external shock, and rapid shift to Asia. The Iran War of 2026 represents exactly the external shock scenario that Choileva identified as the second most likely outcome. And her analysis suggests that such a shock could lead to either dramatic decline of the petrodollar system or its reinforcement, depending entirely on whether nations flee to dollar safety or accelerate their escape from it. The data from Iran's Hormuz yuan toll, where Tehran has been selectively allowing tanker passage in exchange for yuan-denominated settlements, suggests that at least some actors are choosing escape acceleration rather than safety seeking. China's cross-border interbank payment system processed the equivalent of $24.5 trillion in yuan-denominated transactions in 2024, a 43% year-over-year increase, providing the operational plumbing for a world where the dollar is one settlement option among several rather than the only viable choice. Hey, buddy, come in. You're such a good dog. The Iran War of 2026 is being covered as a military story. It is also a monetary story, and the monetary story may prove more consequential in the long run than any battlefield outcome. Iran has not simply closed the Strait of Hormuz to oil tankers. It has, according to a CNN report cited by the Foreign Affairs Forum, been selectively conditioning straight passage on yuan settlement rather than dollar settlement, a wartime measure that is simultaneously a sanctions evasion strategy, a geopolitical alliance signal to Beijing, and what Deutsche Bank analysts have described as a potential catalyst that could be remembered as the beginning of the end of petrodollar dominance. Every tanker that passes through the Strait of Hormuz in yuan rather than dollars is a proof-of-concept transaction demonstrating that the global energy trade can function without the dollar as the mandatory settlement currency. The precedent is more dangerous to American monetary hegemony than the military conflict itself. The infrastructure for this transition was not built overnight. China's cross-border interbank payment system, which processed approximately 175 trillion yuan in 2024, according to People's Bank of China data, provides a settlement alternative to SWIFT that has been operational for years and was specifically designed to be resilient against Western sanctions. The mBridge platform, a multi-central bank digital currency system that processed 387.2 billion yuan in payments before the Bank for International Settlements withdrew in late 2024 over concerns about Russian and Iranian access, has continued operating independently, with 95% of transactions denominated in digital yuan, according to Ledger Insights. Russia-China trade reached approximately 55% yuan settlement by 2025. India has been settling Russian oil purchases in yuan, creating a triangular non-dollar energy trading network spanning the Eurasian landmass. The BRICS bloc, which according to IMF data, now represents approximately 37% of global GDP by purchasing power parity and includes Saudi Arabia, the UAE, Iran, Egypt, Ethiopia, and Indonesia, alongside the original 5 members, has been systematically building the financial infrastructure required to make the dollar optional rather than mandatory in energy trade. The bear case on the de-dollarization thesis requires equal precision. The dollar's share of global foreign exchange reserves has been declining for 25 years, from 71% in 1999 to 57% today. And the dollar has survived that decline without a crisis because no alternative has emerged that offers the same combination of liquidity, legal certainty, and geopolitical neutrality that makes the dollar attractive to reserve managers. The yuan faces fundamental structural constraints as a reserve currency. China's capital account controls limit convertibility. Chinese financial markets lack the transparency that institutional reserve managers require. And geopolitical risk cuts both ways. A reserve currency tied to an authoritarian state is not obviously safer than a reserve currency tied to a heavily indebted democracy. Goldman Sachs published research in 2025 arguing that structural dollar dominance would persist for at least another decade, even under accelerated de-dollarization scenarios. The Asia Society report cited above concludes explicitly that complete de-dollarization of the oil trade is highly unlikely over the next 5 years. This channel does not dispute those analyses. What this channel observes is that the direction of travel established over the past 25 years is accelerating, not decelerating, and that the Iran war has introduced a wartime catalyst that the gradual erosion models did not account for. Here's the question that the entire architecture of this video has been building toward. If the world is fragmenting into 2 power blocks, the technate, centered on North America, with the dollar as its monetary instrument and energy self-sufficiency as its strategic foundation, and the third Rome bloc, centered on Russia and China with the yuan, digital yuan infrastructure, and gold-backed settlements as its monetary instruments, then the question for any investor, any saver, any person trying to preserve and grow their wealth across this transition is this: which assets belong to the winning bloc, and which assets belong to neither bloc? The answer to the second question is what makes Bitcoin structurally unique in this framework. The dollar belongs to the first bloc and is under pressure from the second. Gold is increasingly being accumulated by both blocs. Central banks on both sides purchased over 1,000 tons per year from 2022 through 2024. But gold is also subject to confiscation, physical seizure, sanctions, and custodial risk. Russia's central bank gold reserves were effectively rendered inaccessible by Western sanctions in 2022 when $300 billion in Russian central bank assets were frozen, demonstrating that even sovereign gold holdings are not sanction-proof when custodied in Western financial institutions. The yuan is the monetary instrument of the second bloc and is constrained by capital controls, lack of convertibility, and the concentration of power in the Chinese state that makes it an instrument of Chinese geopolitical interest rather than a neutral store of value. U.S. Treasuries are the primary instrument of the first bloc and face the structural headwinds of $39 trillion in debt, $1 trillion in annual interest payments, and a Moody's downgrade that reflects the deteriorating fiscal trajectory. Every major asset class, dollars, gold, yuan, treasuries, equities, is fundamentally linked to one or the other of the 2 power blocks that are emerging from this transition. Bitcoin is not. Bitcoin has no headquarters that can be sanctioned. It has no central bank that can be pressured. It has no treasury that can be frozen. Its supply is fixed at 21 million coins by a mathematical protocol that no government, no central bank, and no army can alter. According to CoinTracker's historical analysis, the maximum supply was established at Bitcoin's genesis in 2009, and no entity has ever successfully changed it in the 15 years since. Not China's mining ban in 2021, not the US regulatory campaign of 2022 and 2023, not the SEC enforcement actions that consumed billions of dollars in years of litigation. The protocol survived every attack because it has no single point of control, which means it also has no single point of capture, coercion, or confiscation. In a world where the dollar's status as neutral global reserve currency is being actively contested, where gold can be frozen at the custodian level, where the yuan requires Chinese state permission to hold, and where U.S. treasuries yield less than inflation after accounting for the fiscal trajectory, Bitcoin's fixed supply and sovereignty-free architecture are not just features of a cryptocurrency. They are the defining characteristics of the only monetary asset that belongs structurally to neither bloc. Larry Fink articulated this logic more directly than any Bitcoin advocate when he wrote in his March 23, 2026 annual letter to BlackRock's investors that if the United States does not get its debt under control, If deficits keep ballooning, America risks losing the dollar's world reserve currency status to digital assets like Bitcoin. Fink is not a Bitcoin maximalist. He is the CEO of the world's largest asset manager with $14 trillion in assets under management, writing in a formal letter to institutional clients, explicitly identifying Bitcoin as the most likely alternative to the dollar if American fiscal discipline fails. He is simultaneously managing iShares Bitcoin Trust, iBit, which holds over 762,000 Bitcoin, representing approximately 3.6% of total Bitcoin supply, according to CoinDesk data, as of April 2026. The man who controls more retirement capital than anyone else on Earth has assembled the largest single-entity Bitcoin position in financial history, while publicly warning that the dollar's reserve currency status is at risk. This channel does not require you to agree with Jiang's framework to find that fact structurally significant. The on-chain data reinforces the structural accumulation thesis from a completely different direction. According to AI Invest's analysis of on-chain metrics from early March 2026, wallets holding over 1,000 Bitcoin accumulated 270,000 Bitcoin over a 30-day window, the largest monthly accumulation by addresses of that size since 2013. Bitcoin exchange reserves have fallen to 2019 lows, a 7-year low, according to corroborating analysis from investing.com, indicating that the available supply of Bitcoin for immediate sale on exchanges is at its lowest level since before the March 2020 COVID crash. Strategy, led by Michael Saylor, holds 762,000 Bitcoin purchased at an average price of approximately $75,694 per coin, and has continued buying through the Iran war despite sitting on a paper loss, according to CoinDesk. These are not the actions of investors reacting to price momentum. These are the actions of investors with a structural thesis about what Bitcoin is and why its scarcity matters. In a world where every sovereign currency is being inflated, contested, or weaponized. Okay, quick disclaimer. The macroeconomic and geopolitical analysis in this video is strictly for educational purposes and does not constitute financial advice. Trading and investing in Bitcoin and commodities during times of war involves extreme volatility and the risk of total capital loss. Therefore, you must prioritize strict risk management, disciplined position sizing, and your own due diligence, DYOR, before making any investment. These models are probabilistic, not guaranteed, and you are solely responsible for your financial decisions and the consequences of your trades. Stay sharp, use stop losses, and never invest capital you cannot afford to lose. Now let's continue. This channel wants to spend a specific block on gold because the gold data is the signal that anchors the entire monetary transition thesis in something verifiable and independent of any geopolitical framework. Central banks have been net buyers of gold for 15 consecutive years, according to the World Gold Council's full year 2025 report. Central bank gold purchases totaled 863 tons in 2025, well above the 473-ton annual average from 2010 to 2021, and the third consecutive year of purchases above 1,000 tons from 2022 through 2024. The buying is not concentrated in one region or one ideological bloc. Poland led 2024 purchases with 90 tons. Turkey purchased 75 tons. India added significant reserves. China has been reporting consistent monthly additions. The common thread across all these buyers is not geopolitical alignment. Poland is a NATO member, Turkey is a NATO member, but also an increasingly independent operator. India maintains strategic ambiguity between the two blocs, and China is explicitly building the second bloc. What they share is a desire to hold a monetary asset that cannot be sanctioned, frozen, or inflated away by any other country's central bank. The gold data from the Iran war period makes this even more explicit. Gold initially surged when Operation Epic Fury began on February 28th, the classic safe haven response. Then, something unexpected happened. According to Protos, gold fell 18% from its pre-war high to March 23, 2026, posting its worst weekly performance since 1983 in one session. The asset that central banks had been accumulating for 15 consecutive years, that has a 5,000-year history as humanity's preferred monetary reserve, collapsed during an act of war. The mechanism is documented. U.S. Treasury yields climbed and the dollar strengthened during the Iran conflict because the dollar remains the most liquid crisis asset, despite its structural problems. And when the dollar strengthens, gold falls because they are inversely correlated in short-term crisis conditions. Gold proved during the Iran war that it remains the best short to medium-term safe haven for central banks, but the worst short-term safe haven for individual investors who need liquidity during a crisis. Bitcoin, which also sold off initially on February 28th, but then recovered to outperform gold on a cumulative basis, exhibited a different pattern. one that CoinDesk documented as rising floors, with each escalation producing a smaller drawdown as institutional buyers absorb supply at successively higher levels. The contrast between gold's short-term behavior and Bitcoin's structural accumulation behavior during the Iran war contains what this channel believes is the most important signal for understanding the monetary transition described in this video. Gold is being accumulated by central banks and sovereign entities as a long-term reserve diversification away from the dollar. But central banks have decades-long investment horizons and do not care about short-term liquidity. Bitcoin is being accumulated by institutional long-term holders, corporate treasuries, and now potentially 401k retirement plans through the regulatory pathway created by the Department of Labor's Safe Harbor Rule published on March 30th, 2026. And those holders also have long investment horizons and do not care about short-term volatility. The two assets are not competing with each other. They are being accumulated simultaneously by different categories of institutional actor for overlapping but distinct reasons. Gold is being accumulated as protection against dollar sanctions risk. Bitcoin is being accumulated as protection against the entire sovereign monetary system, including, potentially, a future in which gold itself is targeted by whoever controls the block that the holder is trying to exit. The specific data point that closes this argument comes from the SPDR Gold Shares ETF, the world's largest gold fund. According to Protos and multiple confirming sources, the fund lost $4.2 billion in the first week of the Iran war, the largest weekly outflow in its history. Investors pulled 25 tons of physical gold backing from the world's biggest gold ETF within 7 days. Over the same period, U.S. spot Bitcoin ETFs attracted their first positive monthly net inflows in 5 months, pulling in $1.32 billion in March 2026, after 4 consecutive months of outflows totaling approximately $6.3 billion. The directional signal is unambiguous, even if the magnitude is not yet conclusive. Gold ETFs are losing institutional capital during the war, while Bitcoin ETFs are gaining it. That rotation is exactly what Jiang's framework predicts. Not because Bitcoin is better than gold as a short-term hedge, but because Bitcoin exists outside the system that both blocks are weaponizing, while gold remains captive to the custodial and sanctions infrastructure of whichever block controls the vault. This channel has used Jiang's geopolitical framework extensively across 2 videos, and intellectual honesty requires stating with equal force where this channel fundamentally disagrees with him. Jiang has described Bitcoin as the biggest scam in existence and a Pentagon surveillance tool in multiple statements confirmed by BN Crypto, Digital Today, and Crypto News. Wikipedia describes him as a conspiracy theorist who has promoted theories about the Illuminati, Freemasons, Jesuits, and Sabbateans controlling the Western world, and who has made claims about Israel practicing ritual child sacrifice in the Gaza conflict that are not only false but deeply offensive. His use of the title professor — he is a high school teacher at Moonshot Academy, Beijing, not a university professor — has been described as misleading by multiple media outlets. This channel uses his structural geopolitical analysis because his prediction track record on geopolitics is documented and impressive. This channel rejects his Bitcoin analysis because it is not based on any empirical examination of Bitcoin's architecture or monetary properties. The specific error in Jiang's Bitcoin analysis is that he categorizes Bitcoin as an instrument of the first block, a product of American financial and intelligence infrastructure, and therefore is something that will be captured, co-opted, or destroyed if the first block loses monetary dominance. This error is understandable from the perspective of someone who views institutional adoption of Bitcoin through BlackRock, the DOL Safe Harbor Rule, and the Congressional Regulatory Framework as evidence of American state capture of the asset. But it misunderstands what Bitcoin is at the protocol level. Bitcoin's fixed supply, decentralized validation, and open source protocol are not features that can be altered by BlackRock's participation in the ETF market, by congressional legislation, or by any state actor's decision to embrace or reject it. The most relevant historical analogy is the internet in the 1990s. A technology that originated in DARPA funding and U.S. university research was shaped in its early years by American institutional actors, and then became genuinely global and genuinely decentralized in ways that no single state could control, sanction, or monopolize. Bitcoin's relationship to American financial institutions is structurally similar. Institutional adoption by U.S. entities does not make Bitcoin American property any more than institutional adoption of the internet by U.S. companies made the internet American property. The empirical test of this channel's position versus Jiang's is verifiable over time. If Bitcoin is genuinely captured by the first block, if it becomes effectively a dollar-denominated investment product that rises and falls with American financial conditions, then it will behave as a risk asset that correlates with U.S. equities and collapses when the dollar system faces stress. If Bitcoin is genuinely sovereign-free, if its fixed supply and decentralized architecture make it a genuine monetary alternative to both blocks, then it will increasingly decorrelate from both U.S. equities and gold during periods of sovereign monetary stress, accumulate institutional buyers from both blocks, and eventually develop the liquidity and holder distribution that makes it genuinely neutral. The data from the Iran war period provides early but suggestive evidence. Bitcoin outperformed gold by 26 percentage points from February 28th to late March 2026. On-chain data shows accumulation from U.S. institutional entities through IBIT and Strategy, first block buyers, simultaneously with documented increases in Bitcoin outflows from Iranian exchanges according to Chainalysis, which tracked approximately $10.3 million in Bitcoin flowing out of Iranian exchanges in the first days of the conflict. Bitcoin was being simultaneously accumulated by the entity most associated with first block monetary architecture and used as an escape valve by citizens of a nation at war with that block. That is not the behavior of a captured asset. That is the behavior of a genuinely neutral monetary protocol. This block will not give price targets. This channel never gives price targets. What this block will give is the structural investment thesis for Bitcoin in the specific geopolitical and monetary context that this video has built. And it will give it with the bear case, integrated at every step. The bull case is architectural. If the world is transitioning from a unipolar dollar-based monetary system to a bipolar or multipolar system with competing currency blocks, then the demand for a neutral monetary reserve that neither block can sanction, freeze, or inflate will increase as the transition progresses. Bitcoin's fixed supply means that increasing demand against fixed supply produces upward price pressure, not as speculation, but as the market clearing mechanism between a fixed asset and expanding institutional demand. The Department of Labor Safe Harbor Rule, published on March 30th, 2026, creates the legal pathway for the 90 million Americans holding 401k accounts to access Bitcoin through regulated investment vehicles, representing potentially 1% of $14.2 trillion in defined contribution plan assets, or $142 billion, against a total crypto market cap of approximately $2.3 trillion as of April 2026. BlackRock has nearly $150 billion in digital asset-connected assets under management as of the end of 2025, manages the world's largest spot Bitcoin ETF, and has publicly recommended a 1 to 2% Bitcoin allocation in diversified portfolios in its December 2024 paper sizing Bitcoin in portfolios. Morgan Stanley, which manages approximately $8 trillion in wealth management assets, has been building toward offering Bitcoin ETF exposure through 15,000 financial advisors. Bernstein reaffirmed a $150,000 year-end 2026 target for Bitcoin in a note published March 24th, citing Strategy's continued accumulation, ETF structural demand, and Iran war resolution as its three primary catalysts. Exchange reserves are at 7-year lows. Whale accumulation is at a 13-year high pace. The halving cycle places Bitcoin in month 11 of its historical acceleration window. The bear case is equally architectural. Bitcoin's correlation with U.S. equities has been inconsistent. During Federal Reserve tightening cycles, Bitcoin has fallen alongside risk assets rather than providing the uncorrelated store of value its bull thesis promises. The Iran war itself demonstrated this. Bitcoin fell 8.5% on the first day of the conflict alongside equity markets before recovering. CryptoQuant's analysis documents that Bitcoin's apparent demand metric, measuring demand relative to new supply, was negative 63,000 coins as of end of March, suggesting that the broader market remains in a distribution phase despite whale accumulation. TD Cowen analyst Jarrett Seiberg warned on March 30th that the DOL Safe Harbor Rule could take several years of court validation before fiduciaries actually include Bitcoin in retirement plan menus. The geopolitical framework that this video has built could be entirely wrong about the timeline. The dollar has been declared structurally doomed in one form or another since the 1970s and has survived every predicted crisis. Goldman Sachs published research arguing structural dollar dominance would persist for at least another decade. Bitcoin trading at $68,000, 46% below its October 2025 all-time high of $126,000, is not evidence of structural strength. It is evidence of an asset that has declined significantly from its peak in precisely the macro environment that its most optimistic proponents said would produce a supernova. The three concrete actions that require no agreement with any geopolitical framework and no price prediction are the same ones this channel has outlined in previous videos. First, understand whether your existing retirement account already offers Bitcoin access through Fidelity's Digital Assets account, which has been available to plan sponsors since 2022 and allows up to 20% Bitcoin allocation for participating employers. Second, research whether a self-directed IRA gives you tax-advantaged access to a spot Bitcoin ETF, such as IBED or FBTC, without waiting for the DOL rule finalization or for target date fund managers to update their glide paths. Third, if you hold Bitcoin in any form, research self-custody with a hardware wallet. Because every institution that holds Bitcoin on your behalf is a counterparty, and the entire monetary argument for Bitcoin's unique value proposition rests on the removal of counterparty risk from the monetary system. The institutions are accumulating, the regulatory architecture is being built. The geopolitical context that makes Bitcoin structurally relevant is not a future scenario. It is the present landscape. Let us compress this into the argument it actually is. There's a 600-page book written in 1997 that predicted the annexation of Ukraine, Brexit, the Moscow-Tehran military alliance, the fragmentation of NATO, and the erosion of American unipolarity. That book argues that the existing world order will collapse, not suddenly, but through the progressive decay of its institutional foundations, and that the powers best positioned for that collapse are those who build self-sufficient fortress economies rather than those who remain dependent on the global system that is collapsing. Two major powers are now implementing versions of that strategy simultaneously. Russia, through the Ukraine war, drone industrialization, and Eurasian alliance building, and possibly the United States through the Iran war, the Greater North America Doctrine, and the deliberate acceleration of petrodollar erosion that forces Europe and Asia into North American energy dependency. The dollar's three structural pillars, the petrodollar, Treasury safe haven status, and Pax Americana, are all under simultaneous stress that has no historical precedent. U.S. interest payments now exceed defense spending according to the Congressional Budget Office's own projections. Saudi Arabia allowed the petrodollar agreement to expire without renewal in June 2024. The Strait of Hormuz is being used to route energy trade through yuan settlement channels. Larry Fink, the CEO of the world's largest asset manager, explicitly warned in a formal letter to institutional investors on March 23, 2026, that the dollar's reserve currency status could be lost to digital assets like Bitcoin. In every version of this transition, whether the Trump world order thesis is correct, whether Dugin's third Rome rises, whether the dollar simply continues its slow, gradual erosion, or whether none of these macro narratives play out as described, one structural fact remains constant. Bitcoin has 21 million coins. No government can print more. No central bank can dilute it. No sanction can freeze it in the way that $300 billion in Russian reserves were frozen in 2022. No custodian holds a master key. The protocol has survived 15 years of attacks from every direction. Mining bans, regulatory campaigns, exchange collapses, market crashes, and has continued producing blocks approximately every 10 minutes, transferring value between any two people on Earth without requiring the permission of any state, any bank, or any institution. That is not a prediction about Bitcoin's future price. It is a description of what Bitcoin is. And what Bitcoin is becomes structurally more important, not less, in a world where sovereign monetary systems are being weaponized, where reserve currency status is being contested, and where every major financial institution, from BlackRock to Morgan Stanley to the U.S. Department of Labor, is building the legal and custodial infrastructure to allow the world's most important asset pools to access it. Jiang thinks Bitcoin is a scam. Larry Fink thinks Bitcoin could replace the dollar. CryptoQuant's halving cycle analysis places Bitcoin in month 11 of its historical acceleration window. Bernstein has a $150,000 year-end target. Exchange reserves are at 7-year lows. The DOL safe harbor rule creates the legal pathway for 401k capital. The petrodollar is eroding. U.S. interest payments exceed defense spending. The Strait of Hormuz is being used to route oil in yuan. This channel does not know which of these facts matters most to Bitcoin's price in the next 12 months. This channel knows that all of them are pointing in the same structural direction, toward a world where the monetary properties of an asset with fixed supply and no sovereign allegiance become more valuable with every passing month. Regardless of what the fear and greed index reads today, you have the map. There's a pattern in financial history that repeats with uncomfortable consistency. The people who understood the architecture before it activated, who read the 600-page textbook that nobody was paying attention to, who watched the petrodollar agreement expire without renewal in June 2024, who tracked the central bank gold purchases that doubled the historical average for 3 consecutive years, who saw the DOL safe harbor rule for what it was rather than what the headline said it was, those people were positioned before the consensus arrived. The consensus always arrives. It always arrives late. And by the time it arrives in the form of a financial media headline, the architecture that produced the outcome has been visible to anyone who cared to look for years. This channel cares. This video exists to give you the architecture before the headline. Whether you decide today to research Bitcoin investment options, to open a Bitcoin account, to hold Bitcoin in a hardware wallet and remove every counterparty from your monetary stack, or whether you simply file this framework away and watch the structural indicators unfold over the coming months and years. The most important thing is that you understand what is being built. Because the people who are positioned on the right side of a structural monetary transition are almost never the ones who learned about it from CNBC. They are the ones who read the architecture before it activated. That is what this channel exists to provide. And if Professor Jiang's third Rome theory is right, if the world is in the late stages of a deliberate transition from one monetary architecture to another, then the question of whether Bitcoin goes supernova is not a question about the price of a digital asset. It is a question about whether 21 million coins with no sovereign allegiance and no counterparty become the only neutral monetary reserve in a world where every other form of money belongs to one side of a war. You have the map. The institutions already see the diamond. If you made it all the way to the end, congratulations. Seriously. It takes real discipline and focus to sit through a dense video like this from start to finish. You're not just watching, you're studying. And that puts you in a very small group of people who actually understand what's being built. Now it's your turn to show you're committed. Comment below with exactly, I see the diamond, if you're locked in and ready for what's coming. Also tell me your city and country, what time it is there right now, how the weather is over there. One of the things I enjoy most about creating content is realizing we're building a truly global community. Thousands of people from every corner of the world, watching at different hours, all chasing the same architectural understanding. Drop your comment right now. I read every single one. Thank you for watching. See you in the next video, and stay sharp.